Welcome to County Portal, your simple source for local government services and public records. Let's get started.
Today we're talking about the SALT tax deduction, a term you've probably heard in the news, especially around tax time. SALT stands for state and local taxes. It's a federal deduction that allows taxpayers who itemize to subtract certain taxes they've already paid to their state and local governments from their federally taxable income. Think of it this way, the federal government lets you reduce the income it taxes you on by the amount you've already paid in certain state and local taxes. So, what taxes count? There are three main types: state and local property taxes, state and local income taxes, and state and local sales taxes. Now, here's a key point: you have to choose. You can deduct your property taxes plus either your income taxes or your sales taxes. You can't deduct all three. For most people, deducting income taxes makes more sense because the amount is usually higher than their sales tax bill, but it's an important choice to be aware of. For years, this was a straightforward and very valuable deduction, especially for people living in states with high property or income taxes, like New York, California, or New Jersey. But everything changed in 2017 with the Tax Cuts and Jobs Act. This law introduced a major new rule, a cap on the SALT deduction. The total amount of state and local taxes you can now deduct is limited to just $10,000 per household, per year. That's $10,000 whether you're a single filer or a married couple filing jointly. If you're married but file separately, the cap is $5,000. This $10,000 cap was a huge blow to residents in those high-tax states. Someone who used to deduct $25,000 in property and state income taxes suddenly could only deduct $10,000, meaning their federal taxable income shot up by $15,000. This is why the SALT cap is so controversial. Opponents argue it's a form of double taxation because you're now paying federal income tax on the money you already used to pay your state taxes. They also claim it unfairly targets certain states. Supporters of the cap argue that it prevents high-tax states from effectively exporting their tax burden to the rest of the country through a federal subsidy. It's also important to remember that you only get to use the SALT deduction if you itemize your deductions instead of taking the standard deduction. That same 2017 tax law nearly doubled the standard deduction, so today, far fewer people itemize. If your standard deduction is higher than all your itemized deductions combined, including the cap $10,000 for SALT, then the cap doesn't really affect you. But for homeowners in high-tax areas, the cap is a significant financial issue. The future of the SALT cap is uncertain, as it's currently set to expire at the end of 2025 unless Congress acts to change it, extend it, or make it permanent. Thank you so much for watching. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe to the channel for more simple explanations on finance and taxes.